Hi all, I'm just going to give you a few seconds to enter the room. I'm a little bit early today, so yeah, take your time. All good. It's good to see some familiar names here. Guys, before we get going, if you have any charts you want me to look at or to share with the other attendees here, please do go ahead and put them in the chat box and I'll get around to them at the end. So yeah, or anything you're looking at, any markets. Okay, guys. So look, good afternoon. Well, good afternoon from the UK. It's wonderful to be back again with you, with everyone as we step into 2023. So first and foremost, from me and the FP Markets team, I would like to wish everyone here a happy new year. Now, for those of you who are new to the webinars that we offer, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. So as usual, there should be no issue with the visual or the sound. If there is, do let us know, and the support team will try and help you out. So it's fine to fire across any questions you have during the presentation, but if it's something you feel that may require a deeper response or a more in-depth response, please consider waiting until the end of the presentation, as we may clear up any queries as we proceed. As usual, guys, quick disclaimer here: trade responsibly. Derivative products are highly leveraged. They carry a high level of risk and are not suitable for all investors. Features of our products including fees and charges, are outlined in the relevant legal documents available on our website. Look, guys, really, this is not investment advice. Although I am going to be giving my opinion on the markets as we progress, this is purely an educational presentation. All right, so let's kick off with a brief look at what's occurred in 2022 and really what were the global themes were during that year, and then what we can expect heading into 2023. So look, really in a nutshell, the main global themes affecting the markets in 2022, as I'm sure we're all aware, were, of course, elevated inflation. This is globally elevated inflation, a historically aggressive policy tightening cycle from central banks, and of course geopolitical tensions. And really these three have been for me, the center of attention for 2022. So I will not go into too much detail here regarding geopolitics, the geopolitics of 2022, but of course, as we're all aware, in early 2022, the world witnessed Russia invade the Ukraine, and an unfortunate war ensued following that, and really shows little sign of abating. This, as well as of course, the unfortunate loss of life, also saw a number of things occur as a result. So, for example, we had supply chain disruptions, we had food and energy insecurity. So prices of staple foods like wheat, of course, increased because of the lack of supply here. increased costs of logistics, and we had an all-round volatile financial market, and currency fluctuations were key as well during that period. Now, one of those markets that were really key was the oil market. So up on the screen right now, I have the West Texas Intermediate, the WTI. This is one of the benchmark oil. This is one of the major benchmarks for oil. So look, many European countries rely on oil and gas to heat their homes, fill their cars up, and obviously power the factories. The conflict between Russia and Ukraine has, it did help. It underpinned worldwide inflation and really hiked the price of oil, natural gas, and of course other staples as well. We only have to look at the price of the oil chart here. This is the daily time frame, just to be clear. Price spiked to a whopping high of $126 per barrel at the onset of the war. So, but look, as you can see, though, we did top out going into July, just heading into July of 2022, and we have since seen a downtrend emerge. And a downtrend, as most of us are aware, a downtrend is simply a series of lower lows and lower highs. And as you can see, we have minus these two tops here. We have seen a downtrend occur. All right, so I have got a message there asking for my WhatsApp number. Look, I'm afraid I cannot hand out my WhatsApp, my phone number. So yeah, any questions relating to this presentation, I'm happy to answer. So please do go ahead and fire any questions you have. All right, so as you can see, we are very comfortable below the $100 a barrel mark right now. And after the price of, as I said, after the price of oil formed the top, we are in now a clear downtrend in the oil market. And this is the same for Brent as well. And Brent's simply another benchmark for the oil market. All right, so in terms of global equities and bonds, so right on the screen right now, we have the FTSE All World Index, we have the MSCI, that's the Morgan Stanley. Now I forgot what the CI means. I do apologize. It's Morgan Stanley something World Index. It's to do with the equity market. It's a MCSI World Index, and then we have the Vanguard Total International Bond ETF. Now, the idea with these three charts is I really wanted to show how equities and bonds performed during 2022. So looking here, it is safe to say, let me just get the pen out. It is safe to say that whoa, sorry about this. Seems to be an issue with the. Okay, so it's safe to say that bonds and equities had it was a very difficult year for the bond and equity market. So it was it would have been a very difficult year for investors of these asset classes. And as you can see, all ending in firmly in negative territory for the year. Now, bonds usually act as an effective source of diversification within portfolios, which is really their traditional role. But given that there's a stronger correlation, there was a stronger correlation between the bond and equity markets during this time, we saw a collective decline in both markets. Now, the reason behind this really is largely due to the policy tightening regime that we've seen across all major central banks. I will be touching on that shortly. All right, no worries. I see. I'm so sorry. I won't even try and pronounce your name. I'll just say D if that's okay. Yeah, I do see your response, and no problem. Ask a question at the end or ask a question during the presentation. It's fine as long as it relates to the slide we're talking about. All right, so as I said, bonds could not act as an effective source of diversification. And as a result, we've seen a collective decline in both bonds and equities. Now, just to give you some context here with all of these major indexes. Now, the The FTSE All-World Index covers approximately 98% of the world's investable market cap, and this is according to the FTSE publications. I think it totals to around 4,000 stocks. This index tracks in over, I think it's around 50 countries, 50 different countries. The MSCI World Index covers more than 1,600 securities across large and mid-cap size segments and in 23 developed markets. Now, finally, the Vanguard Total International Bond ETF is, as far as I'm aware, is the largest bond ETF. Now, for holding details, you can, there is a detail page on the Vanguard website. Now, if you're interested in trading ETFs, but want to trade a derivative of an ETF, you can look at the CFD's FP Markets offer. So we offer ETF CFDs on both the MCSI and, of course, the Vanguard Total International Bond ETF. So do check those out if you're interested in trading those instruments. Just bear with me a minute. I seem to be having an issue with the... Okay, there we go. All right, so next up we have inflation. Now, this really needs no introduction. I'm sure we're all aware of what occurred in inflation, global inflation during 2022. As you can see from this trading view chart. Now, just to be clear, guys, I should have really made that clear on the previous chart. This was courtesy of the Financial Times, so just to make that clear. All right, so back to this chart. This is a chart made up from TradingView, and it shows the global inflation levels for UK, well, the top ones, UK, Europe, Australia, and the US. And we also have the BOJ below and China's inflation level below that. Now, as you can see, we have experienced broad upside pressures during 2022, and this clearly remains, given, and these are current levels, and this clearly remains an ongoing theme for many countries, for these countries and many countries. Though you will see that from this chart, the chart I'm presenting now, the 4 countries I just mentioned, we are seeing signs of a potential peak. Now, this is particularly obvious in the US market. The US in terms of US inflation. As you can see here, the bolded blue line, I guess you could say, we peaked at around in June at 9.1%. Well, I say peak. This is what many are considering the peak right now. Currently, for the US, the current inflation is at 7.1%. So we've eased for 5 successive months after penciling in this June 2022 peak. So yes, there's something to. But look, in terms of the UK and Europe, I think it's far too early to tell whether this is an actual peak or not. As I said, specifically for the Euro area and the UK, with the Euro area's inflation currently at 10.10% and the UK inflation at an eye-popping 10.7%. Now, according to the ONS, and that's based here in the UK, the Consumer Prices Index rose by, as I said, 10.7% in the 12 months to November, down from 11.1% in October. Now, many of the Bank of England were forecasting that the peak in inflation would be around 11%. So time will tell if that's the case here. Now, in terms of the central banks for 2023, first off, let me just highlight when the next meetings are. So I'm just going to go through the major central banks here. So for the Bank of Canada, the next meeting is this month at on the 25th of January. Now, there's currently a 72% probability priced in for another 25 basis point hike. This is as of today. Now, for the Bank of England, we have a 68% chance of a 50 basis point hike, and that's on the 2nd of February. The 18th of January, we'll see the BOJ take the stage, but look, the next move is projected to remain on hold. And that's at 93% according to short-term interest rate markets right now. Now, the current rate for the Bank of Japan is minus 0.1%. The European Central Bank, that's on the 2nd of Feb. That's the next meeting, and we have a projected change of 50%, and that's at 79%. That's at a 79% probability. All right. So for the Fed, many banks, many desks are expecting a 25 basis point hike for the Federal Reserve. This follows a 50 basis point hike at the previous meeting. For a 25 basis point move, we're currently pricing in, well, the markets are currently pricing a 75% probability. Now, that's on the 1st of February. So the RBA, the Reserve Bank of Australia, 7th of February, 65% probability of a 25 basis point hike. And that's really it. That's really all I really wanted to get across here. But up on the screen, I have the 4 major central banks I really wanted to talk about. So the Fed for 2023. Now, the price changes, the previous price changes, I'll go from about September to November to December. So actually from June to November, we had 4 consecutive 75 basis point interest rate increases. That's the federal funds rate. In December, we had a hike of 50 basis points. And as I said, we are projecting the market is projecting a 25 basis point hike at the 1st of February meeting. Now, the terminal rate, the expected terminal rate, is currently priced in at 4.75%. This is the target range for the Fed funds rate, between 4.75% and 5%. So do keep that in mind. Now, the terminal rate is essentially defined as the peak location, if you will, where the benchmark interest rate for that central bank, so think of the federal funds rate, will come to a peak, if you will, and before the central bank begins cutting rates. We have the ECB. Look, the expected terminal rate for the ECB currently is at around 3.5%. Just to give you some context here, the European Central Bank's interest rate, benchmark interest rate, is only at 2% right now. And as I said, we are expecting, well, the market is expecting a 50 basis point hike. That's around 79% probability, guys. The BOE, right? The BOE. So we had a number of interest rate hikes here in the UK. November, 75 basis points. That was an eye-opener for sure. In December, we had 50 basis points. Now, the expected terminal rate for the BOE, and remember the BOE's next meeting is on the 2nd of February, and we have a 68% probability priced in for a 50 basis point hike. Now, the expected terminal rate, if I've not already said that, is around 4.5% for the BOE. For the Bank of Japan, look, as you can see on the screen here, the Bank of Japan is still on hold, though the recent widening of the yield curve, I'm sure we all read about that, indicates that policy could really be altered. The current policy rate, as I've already mentioned, is at minus 0.10%. I just got your message there. Kindly have a look at the NASDAQ 100. So I have the S&P 500 chart to have a look at soon. But I can look at the NASDAQ 100. They move very, very similarly, so we may see the same thing play out there. All right, so just really to finally on to growth and recession for 2023. Are major economies heading into recession is certainly the question. Some say we may already be in recession here in the UK. Look, there was an absolute awesome article put out by Bloomberg, and at the beginning of this month, I think it was around the 3rd of January, and what it showed was in in very clear form is what major institutions expect for 2023. It's well worth a read, and it can certainly do a far better job than I can than explaining what we can expect for the year ahead. So what I'm going to do is I have the link here. I'm going to put that in the chat box for you guys. Do check it out because it's well worth a look, as I said. Now you should all have that link as I speak. All right, so technical outlook. So with many of these, the global themes I've just briefly spoke about still ongoing. Market participants still really have that. They have plenty to get their teeth into as we step into 2023. Now, the technical space, so I'm primarily a market technician, and it really does offer some very interesting scenarios to consider as we head into the year. Now, just to be clear, guys, these are my views and do not constitute any form of investment advice of any kind. All right, so I will begin with the King Dollar. And just really briefly, this is the number one most actively traded currency globally. Now, this is not just me saying this. This is according to the latest BIS, the Bank of International Settlements statement. The US dollar was on one side of 88% of all trades, and this was unchanged from 2019. The share of the euro decreased marginally to 31%, and those for the Japanese yen and the pound sterling remain unchanged at 17% and 13% respectively. All right, so let me just move my screen over. Just bear with me a minute. Might take a little bit of time. Okay, now we should be able to see the screens. All right. So first up, as I said, we're looking at the dollar index. Now, the US dollar index represents a geometric average weighted calculation of the US dollar's position versus 6 major G10 currencies. This includes the euro, the British pound, and the Japanese yen. And how I always like to remember the ending part, because I never really focus on the last 3 because of the weightings. It's CSS, so it's Canadian dollar, Swedish krona, and Swiss franc. All right, so the index finished, as you can see on the monthly time frame here. So the monthly time frame is on the left-hand side, and we have the daily time frame on the right-hand side. So with that being said, we can see that the dollar index, as I said, did close higher despite this pullback here. To be clear, the index actually finished in positive territory, up by 8.2%, and this was despite this 10% decline from this ascending channel, which I will get to shortly. And this was in Q4 of 2022. Heading into Q4 of 2022. Sorry, we started topping out there. So out of the monthly time frame, again, the left-hand side of the chart, it's clear that the index hit this ceiling, this ascending channel, and this was extended from the high down at this point here of 103.82. Now, for anyone that follows the RSI, you can see that this was complemented by the negative divergence out of the relative strength index, which is a very popular momentum gauge. So this was a reasonably high probability trading scenario for anyone that wanted to short the dollar at this point. Yes, so it was as you can see, it reacted nicely from this ascending channel resistance. And what it's done is it's really landed the dollar as we headed into the close of 2022, and really now, as we're looking at the early stages of 2023, we are playing around with the upper edge of this decision point. And as you can see, this decision point is at 101.40, 103.91. Now, why is this a decision point? Because it was simply, a lot of traders will label this as demand, and I'm not here to say you're incorrect, but for me, it's a decision point because it was not really formed off of anything. So if we look closer, this is an area where a clear decision was made to push higher, to break this high and this high. So we broke 2 highs in strong fashion. And importantly, it was not formed off of any type of resistance turn support at this point here. So this was, for me, was a clear decision point. And these are usually very, very high probability areas to trade from. In this case, the dollar, we did see this month, we have seen price, taper off from the highs of 105.63. So it's not been, so buyers did attempt to come in from this area, but have failed in quite some fashion, actually. But still, this area remains in play. And do note that the RSI is also closing in on the 50 center line, which is the center line for the RSI indicator. Now, onto the dollar index daily time frame. So this is somewhat shorter term comparing to the monthly time frame. We are now within this area of support. Now, this area of support is between a Quasimodo support at 102.36 and 103.42. Also, to note, for anyone that follows the moving averages, we do have what's known as a death cross. A death cross is where the 50-day simple moving average crosses below the 200-day simple moving average. And it's considered a bearish signal among technicians. Whether you trade on the back of this depends on your strategy, of course. But what you'll see is long-term trend traders may adopt this within their overall strategy. So just to give you an example here, 50-day simple moving average crossing above the 200-day simple moving average here is a long signal. And you would have held the position all the way up to here until this death cross formed at this point here. Now, this would be considered a golden cross. A golden cross? I think it's a golden cross. Golden cross, death cross. I think that's what that is referred to. A golden cross or golden cross, I think. So yes, just a little bit of a context there for you in regards to the moving averages. Now, where do I feel that the dollar is headed for Q1 into the year ahead? For me, this decision point on the monthly time frame here is really quite a substantial technical structure, and it's so well placed within the overall trend for the dollar. So look, I mean, since April of 2011, no one can argue with this. We are trending higher on the dollar index. The long-term trend remains favored to the upside, despite what we're seeing on the daily time frame here. So this could be all part of this correction at this point here, and we could see buyers come in from here. Now, this is the reason why I've highlighted this area of support, because this area of support is actually located within the upper edge of this decision point. So you may see buyers attempt to come in from this area and try to push higher on the basis of where we are positioned on the bigger picture. So do be aware of that. Now, we do have support, I would say support on the RSI, but it looks like it got broken at 41.42. So I will delete that now. But overall, if you have a look, we do have divergence forming. So we have a lower low formed on the dollar index, the daily time frame, and we have a higher high potentially forming on the RSI. So do be aware of that. Let me actually just mark that up so you see. And there we have the lower low formed there. So we do have potential divergence forming on the RSI. So for me, really, I am a dollar bull for the time being, according to what I'm seeing on the charts. Now, what this could trigger then is a rally in the dollar-based currency pairs, which may weigh on major counterparts like the euro. So the euro, this is a euro-dollar monthly time frame. So I've gone very high time frame here because I really wanted to give you a broad-based look of where I feel that the markets may be headed for this year. Now, I'm a big fan of technical confluence, and as you can see here, we do have some confluence in play. Just to explain, we have an ascending support turned resistance. Now, this is not a trend line. You'll see many technicians label this as a trend line. There is no trend. So a trend line's primary purpose is to define a trend, but this is defining very little, and a trend line should not cut through price. It should be free flowing, if that makes sense. So a trend line should be from this point to that point. We could even have it at that point until it was broken there. So from this point to that point. So a trend line should not cut through price, just to be clear. So that's why I've labeled this an ascending support turned resistance. The reason why it's potential resistance now is because it was breached. Okay, so this alongside a resistance area, a resistance level, at 0.884. 0.884. Now, for anyone that watches has watched my previous presentations, you will note that this is actually a Quasimodo support turned resistance, and you may even remember that I have spoke about these in detail. So if you're interested in these types of support and resistances, please do go ahead and visit our archived webinars where you can access those. In addition to this, we also have the 50% retracement ratio. As you can see here, look, the 50% retracement ratio is not a Fibonacci number. It is simply 50% of this leg here. All right. So if you try and calculate the Fibonacci numbers, you'll never get 50%. But the 50% retracement ratio does have a knack, if you will, of of holding price, if you rejecting price. So all of this combined alongside the relative strength index on the verge of clipping the underside of the 50 center line, which can and often does offer some form of resistance, I feel that this is an area we may see sellers come in from. Now, the euro dollar, if you remember at the beginning, I said about the euro dollar having the, I think I said, excuse me if I'm wrong, but the euro has the largest weight within the US dollar index, and that's around 57.6%. So this is the reason when you see the euro decline or when you see the dollar rally, you'll often, not often, but you'll very, very often see the dollar index fall. All right. So as you can see, we are now rallying higher on, this is a pullback, right? This is a pullback within a downtrend. And on the dollar index, we have a correction within an uptrend. All right. So it's an inversely correlated market. When one goes down, one goes up. So given that we are in demand or in a firm decision point on the dollar index right now, and we are approaching a clear resistance on the month. So this is a monthly decision point, and this is a clear resistance on the monthly time frame for the euro dollar. Again, this is at 0.884. We could see a bearish reaction unfold from this point. I hope you can see what I'm seeing here, guys. So do keep an eye on this, especially for the year ahead. So this is a long-term chart. So we could see a bearish reaction here and a continuation lower for the euro and a bounce higher for the dollar. Because don't forget, although the Fed are looking to slow their policy tightening, they are still hiking rates. So that should, or it could still underpin, offer some support for the dollar. All right, so for anyone that's unaware, this is the CRB. This is the, or it's sometimes referred, or it should be referred to as the Refinitiv Core Commodity CRB. And this is the Commodity Research Bureau Index. Now, I use the CRB mainly to track the commodities market. Just to be clear, this index tracks 19 commodities, and this includes energy contracts, agriculture, precious metals, and industrial metals. And the index really acts as a representative indicator for the commodity markets. There is also another well-known commodity index, and that's called the S&P GSCI, and that's the Goldman Sachs Commodity Index. And the difference between this, the GSCI, and this index is really the GSCI is more focused on towards energy contracts. So this is why if you plot the GSCI alongside the price of oil, you'll produce a very strong correlation between the two. I think it's approximately actually 60%. It is 60%. 60% weighted towards energy, with around 20% weighted towards the WTI and Brent markets. So it's a strong correlation, guys. So looking at the CRB index, this is the weekly time frame, guys. Again, for commodities, we had a clear break of a trend line support. Again, a very, very basic technical outlook. I will say over the years, I've met a number of traders, and the best traders I've met keep it really simple. It's incredibly simple how they trade, and these are very successful guys and girls, and they really do. I mean, I'll give you one example of someone I spoke to a few years back, and they were trading the futures market, and they were trading with trend lines, but they were trading. What they did was they looked for these areas here. So if I zoom in, so you have a high, so a basic trend line here, and they look for a break to the upside, and they would trade the retest of that trend line. That's it. And they were successful. Obviously, there was a few other components, I would imagine, especially with futures, you can trade volume and things like that. I just really wanted to emphasize that point. There's no need to have 10 or 12 indicators and about 300 moving averages on your chart where you cannot see the price action. There's really no need for that. All right, so enough of a rant, really. So for the CRB, we are trending lower right now. Again, this is the weekly time frame. We have come off negative divergence off the RSI. I mean, look how beautiful that was. Even the price action was telling you there that upside momentum was decreasing. So we really even didn't, once you get experienced with price action, you can tell what's happening in the market. Here, very strong upside momentum, and that's shown on the RSI. We are driven into overbought territory. And at that point, we have a clear divergence set up in play. Now, just to be clear, guys, divergence for the RSI should be marked between closing prices, not the extreme highs, because of how the indicator is calculated. The indicator is calculated using closing prices. So we should mark the price action up via closing prices, not the extreme highs. All right, so we had negative divergence at a clear resistance. Now, this is a very long-term resistance. As you can see, resistance, support. Support, resistance is a very, very long-term. I think it goes all the way back to 2006. So it's a huge, huge resistance level. And it was accompanied by negative divergence. Now, I won't go into all what happened after that, other than we broke that trend line support and retested. This is exactly what I was saying, how that lady that I spoke to traded. So she traded the break of this support. She would trade the retest of that breached trend line support at these points here. And as you can see, it worked nicely on the CRB. So we are now lower, and last week, I think it was last week, we did actually form a minor lower low. So we are still in a downtrend in the commodities market. If you look at some of the charts, for anyone that's familiar with the intermarket analysis, what we look for is a drop in the bond market. So look at the 30-year treasury bonds, look at a drop in the bond market, and then a drop in stocks, and a drop in commodities, then a drop in the US dollar. And if you look at that now, you can see that playing. The only difference is the 30-year bonds have rallied. Okay, the 30-year bonds have rallied. So we could be in for it could take some time to play out, of course. We could be in for a turnaround in the stock market. When is very difficult to say. I just thought I would put that out there if you're interested in intermarket analysis. And that's really between the four major asset classes: stocks, bonds, commodities, and currencies. So really, for the commodities market, we are still lower. We've printed a minor lower low, as I said. Support to be watched is 256.89 on the CRB. So we have lower to go on the CRB. So commodities could potentially push lower. And what this could do is push, because of the inverse correlation between commodities and the dollar, we could see the dollar rally. And that could support our decision point we spoke about earlier. So support, as I said, 258.89. If we break below here, I see very, very little until around the 236 27.47 support, followed by a pattern profit objective of this picture perfect. It's just a picture perfect bearish flag. Okay, picture perfect. I really like this one. But yeah, we could see continuation selling all the way down to 231.72, which is the pattern profit objective for this bearish flag. All right, guys, on to equities. Now, I did have a question regarding the NASDAQ 100 chart. Hopefully this will suffice because I haven't marked up any NASDAQ charts, but I think they are roughly in line with each other. So from the left to right, we have the monthly, weekly, and daily. So the monthly time frame, as you can see, we had a correction in 2020, a correction of over 30 or around 35%. And that was the pandemic, that was the COVID-19. And now going into 2022, as I said at the beginning, do you remember we pinned up those charts, the MSCI World Index and the FTSE World Index, and we saw that equities did indeed tank during 2022. And so it's no surprise that the S&P 500 also tanked as well. And we did reach a low of, well, a close. Let's go to the close. So it was around 26% rounded up. So 26% correction. We have now bounced higher, but buyers are yet to really show much in terms of commitment. But look, guys, we are still in an uptrend on the in the S&P 500. But look at this negative divergence that occurred just at the top of this where price peaked. This was just a picture perfect negative divergence for the RSI. It's in overbought territory as well. So yes, we are in correction territory on the monthly time frame. Now, when you combine time frames, you get a deeper picture. Well, I do anyway. So we look at this is the weekly time frame. Now we have bounced from support at 35.89, which was complemented by a 50% retracement at 35.12. We have bounced, but we are capped to the upside with this by this trend line resistance, and this was drawn from the high of the 48.17. So it's a clear trend line resistance that we need to keep an eye on. We really need to keep an eye on this trend line resistance. If we break above here, this is a sign that you can say this is the primary trend for anyone that follows Dow theory. Primary trend. I tend to look at the weekly time frame for the primary trend, but look, for this case, we can say this is the primary uptrend. Now, a break of this trend line resistance would help confirm the overall primary trend. Now, on the RSI, we have what's known as an ascending triangle forming. This is the positive divergence at the bottom, but altogether we have a ascending triangle. Now, ascending triangles are generally continuation patterns in an uptrend, but they can also form at reversal in downtrends and form reversal structures. So that's just something to be aware of, and we are seeing that form on the RSI. Just quickly, guys, just in terms of the notable losers for 2022. So I did note that Apple dropped 25%. This is really the FANG stock. So we have Facebook or Meta, Apple, Amazon, Netflix, and Google. So Apple dropped, as I said, minus 25%. Amazon dropped a whopping near 50%. Netflix dropped 51%. Facebook dropped 65%. And Google dropped nearly 40%. Just to add on to that, Tesla dropped 65% in 2022. It's just insane, an insane decline for these major tech players. So as you can see, back onto the chart, S&P 500, broad uptrend. If we break this trend line resistance, I will see that as a moderate confirmation. Buyers are now looking to take control. Now, if we look at the daily time frame here, this is much shorter term, of course, than the monthly and weekly time frames. We are seeing a resistance area. So we got resistance at 39.21. We have a 50% retracement at 39.32, and we also have a 1.272% Fibonacci projection. There we go, projection at 39.38. Now, the Fibonacci projection, what I just mentioned there, the 1.272% is actually If anyone follows Scott Carney and is interested in harmonic trading applications, this is labeled as an alternate AB equals CD. And as you can see, it's reacted very, very nicely so far. So this is something to be aware of. But really, my focus for the year ahead is on the monthly and weekly timeframes. Keep an eye on this trend line resistance and keep an eye on the broad trend. Now, onto Bitcoin, guys. Look, Bitcoin has literally fallen asleep since I think it was FTX fallout. And it's really fallen asleep since then. And that was since, early November. But look, we have traded higher. We did test the underside of this resistance at 18,099 and we held. And this was complemented by the 50-day simple moving average. Look, just to give you a bit of a context with the Bitcoin charts and really the overall crypto market. So the crypto market did not do well during 2022. I think it would be fair to say that Bitcoin has seen better years. In fact, Bitcoin ended lower by around 60% against the US dollar on this chart. This wiped out gains for 2021 and around 50% of the upside seen in 2020. It's the largest 1 year decline in history, in fact. So look, just really when the price was trading around 68,000 in November, this is up here. Would you have believed me if I said in January of 2023 we'd be talking about Bitcoin under the 20,000 threshold? You probably wouldn't have done. I mean, it was flooded with Twitter by the dip. I think it was by the dip because we were trending higher and it was going to go to the moon. But look, according to the charts, we are in a clear downtrend right now, a clear downtrend. A downtrend is a series of lower lows and lower highs. So according to the charts, we are still in bearish territory and we could head lower. So with that being said, again, this is the daily time frame, guys. We're in a clear trend. We have a lot of wood to chop through if we want to push higher. We have the 200-day simple moving average at 19,543. We have a number of resistances, including the 20,000 threshold, including the resistance at 21,924. And look, we also have these clear-cut bearish pennant pattern and the bearish flag. Now, as you can see, the profit objective for the bearish pennant was indeed reached, and this was at 15,523. This was completed. So it was this pattern here. We broke out strongly to the downside and eventually touched gloves with that pattern profit objective. Now below here, should we continue lower as the trend suggests, I do see an AB equals CD pattern at 12,216, and this is from A to B, B to C, and all the way down to D. And look, if we do push below here, we could even reach as far south as 7,674. And this is taken from this bearish flag. This is this pattern profit objective from this bearish flag. So it could take it like this pattern profit objective for this bearish pennant. We could take some time to reach as far south as here. Now, do I believe we could reach as far south as here? To be quite frank, I do not know. It's impossible to know where Bitcoin's headed. But all I can go on is past price action, and we are in a clear downtrend right now. Sellers are in control, so I do assume that we will continue to see that play out. So for me, Bitcoin is a sell on rallies at this time. Just really quickly on the oil market, I thought I'd round up here. So, look, this is a monthly time frame, guys. So a huge, and this is the downtrend we was talking about in the previous slides. Look, we are now testing the limits of this support at 74.81, $78.11 per barrel. This is a major support area for the price of oil, and this is the WTI price action. So if we break below here, look, there's scope to move lower to this support at 65.23, which has a 50% retracement complementing that level at 64.44. All right, so look, buyers do not look in good shape at this point. They really do not. So I do feel that sellers have the upper hand at this point, and further selling will likely materialize in the oil market. Right, so that's really all I have in terms of the charts that I was going to show. So, are there any questions, guys? Please, I do not see any questions in the chat box other than the NASDAQ chart. I hope I covered that with the S&P 500. Yeah, look, on the 24th of January of this month, 24th of January. At the same time, guys, we have a very important webinar on risk management. Do be sure to register for that. What is risk management? Understanding clear risk management techniques, and we'll also have a Q&A there. Again, if there's anything really specific you want us to talk about, or any comments regarding today's presentation, we love to hear from you guys. So please be sure to send in your suggestions to either support@fpmarkets.com or alternatively marketanalyst@fpmarkets.com. Let me just check. All right, so look, guys, we do have an FP Markets trading hub. It's packed with educational articles and content and analysis and all that good stuff. So please do be sure to pop along and see what you can and see if there's anything there that interests you. We also have a trading academy, guys, with clear videos on concepts that could help your trading. Really well written articles as well, complementing the videos. So please be sure to check those out. The links are in the chat box as I speak. So with that being said, this is pretty much all I have for you guys today. Thank you so much for taking the time to join. I hope you're able to walk away with a more clearer, at least a clearer technical picture of what we can possibly look out for in the upcoming year. As always, I am available. Well, the research team is available from marketanalyst@fpmarkets.com. If you have any questions regarding anything in terms of the markets or analysis, please be sure to reach out to us and we'll get back to you as soon as we possibly can. On that note, ladies and gentlemen, thank you so much once again, and I'll see you all again later in the month. Thank you so much. Goodbye.